Yeah, it's kind of crazy. I just tried it on my second account and it worked just fine, but I can't get anything to work on my main account. So kind of crazy. I'm not sure what's going on. My fault or his fault. I don't know. Oh well. We'll have the diehards here. You, Oleg, and me. And I have this special question about soccer, which I thought was just a fascinating idea that this one guy posted on Twitter. And I don't follow soccer, a lot, but I am fascinated by the numbers, and I do follow ice hockey. And it's a very similar question. If the goalie, if the shot on goal is not close, and the goalie doesn't even have the requirement to save it, is it is that a bad shot? I thought that was a very interesting question.
I'm trying to wrap my head around it. I don't really understand it.
Yeah, he was trying to compare it to like an air ball in basketball. So you don't even hit the rim, so the ball has no chance of going in. And then if you try to make too fine of a shot in soccer, the goal it sails past the goal. The goalie doesn't even have to save it. Is that the same thing? And I thought that was a fascinating question, and he makes it sound like it's a total waste of time if you don't shoot the ball within the space of the goal. And so I think that that's incorrect. I have studied a little bit of ice hockey, and they keep track of shots on goal, which mainly mean shots that the goalie must save. And there's not a high correlation amongst shots on goal to goals scored as there is with just plain old shots. Even the shots that the goalie doesn't even have to save, that tends to be more correlated with with scoring. And I think it is similar to this idea that in order to score in soccer or in hockey, you have to try to put it with outside of the range of the goalie. And if you're only shooting it right at the goalie, and okay, it's within the goal, but he has an easy chance of getting it, you're not going to score very often. So you're not trying to hit those corners. And hitting the corner just inside the pipe or just outside the pipe, this is the cost of shooting. You're not always going to make it, and it's going to be inside or outside sometimes. But you must aim for those hard to get places in order to get it past the goalie. This is professional sport with talented goalies as well as talented kickers. Okay, that's all I have. That's kind of outside of my range. What do you think?
It's beyond my pay grade, Jerry. I think we need an elite sportsman on here to talk about it.
Yeah, I was afraid that that was going to go nowhere, but I still think it's kind of interesting. And like most things in life, it's totally a math question. Um, and anyways, we had some amazing email exchanges, you, Moritz, and I this week, and I thought that was just amazing. I posed these questions and just trying to get at uh, see if I'm on the same page with you and Moritz, and then you guys proceeded to write pretty much the first chapter to a good trading book, back and forth, back and forth. It was quite amazing, and I'm going to save that email, those emails, and refer back to them in my later years because, and I think it just brings up a very good point. That's really a point that we have a very difficult time getting across. And then someone else picked up on this idea that when you were discussing convergent trading and divergent trading, and they mentioned something about compounding. And I think it's just difficult for us to get across how powerful it is to use closed trade equity or something other than current equity to size our positions so we can extricate ourselves from the problems of using leverage and changing our trading size back and forth as we make and lose money.
Yes, Jerry. So that conversation you, me, and Maritz had, it spilled over into Twitter as well, where I kept it going on Twitter with a number of tweets. So I think it was Rob Carver's interview with Niels that sort of started this off. I'm just trying to think the basis of the question. Do you remember what it was?
Yes, it was definitely Rob. Um, it's going to take me a couple seconds to remember it, but it was definitely Rob, and that was a very good interview. Rob made some really good points. You know, if you go in and listen to Rob talk sometimes to Niels, and you pull out the quotes just so and massage them pretty nicely, Rob actually starts making sense. In other words, if I can get a hold of Rob's quotes and kind of add and subtract a few words from them and leave out some of the other stuff, Rob's a pretty darn smart guy, and he should write a few books, I think.
Yes, Jerry. I'm just going to try and pull up the conversation to try and work out what it was we were discussing. I think it was in relation to. Um, that's right. It was in relation to drawdowns versus compound annual growth rate. So it was Rob was saying, which is quite correct, that if you double the leverage of a trading strategy that has a initially under say 1 times leverage, it has a drawdown of say 10% and a compound annual growth rate of say 5%. If you double the leverage, the drawdown, there's a linear relationship there where the drawdown goes from 10% to 20%. So it's a doubling of the drawdown when you double the leverage. But it's not the same impact on compound annual growth rate. So the original 5%, when you double the leverage, doesn't double to 10%. It goes to something around 7%. And this is because the compound annual growth rate is what we were talking about is a path dependent metric that is non-linear in its relationship to leverage. So you inevitably you don't get the doubling when you apply leverage, which therefore means that for generally speaking, as you sort of increase the leverage of your trading system, you're not really doing yourself many favors because you are effectively diluting the relationship between the drawdown and the compound annual growth rate. And this therefore got onto a discussion in Twitter where I was saying, well, that's where you apply leverage or position sizing to maximize your CAGR. And yes, we run into that problem. However, an alternative way of increasing your compound annual growth rate is to diversify wider. And that's where I started talking about system diversification, just as an example to demonstrate that when we apply system diversification, what we're effectively doing is we are increasing the frequency of outliers in that distribution of returns. When we trade a suite of systems, like an ensemble of systems, we are increasing the frequency of the distribution throughout that time series, and that those outliers actually give lifting power to compensate for the drawdown that's achieved in the relationship between drawdown and compound annual growth rate. So an alternate way, as opposed to applying leverage to a portfolio, a better way, I believe, in my opinion, is to actually diversify wider, which therefore eliminates that, what I call the compounding drag associated with drawdowns.
Hi to everyone. Of course, very happy to be here. Was a little bit upset when I saw that there is no room. There's a program technical issues with the room, so it's all okay now. And I want to say that now I'm in a special place for me. I'm in the yard, in the yard and near houses. But in this yard, for a few years, very often as I have said before, I have a habit to listen every day an episode of Systematic Investor podcast, and I do it for 3 years every day, almost every day, not every day, but almost every day, except Sundays, maybe some Saturdays. And I went to this yard, to this bench, and listened. I didn't want to be bothered by my wife at home. So, and everywhere that I went to, maybe to the forest, to the seaside, and not far from my home, to this yard. And it was rain, it was wind, and it was in summer. It was very hot, and I was very happy when I listened my episodes, my favorite podcasts, Doctors and Plugs. I did notes, and I remember this happy moments. And I decided today to go to this yard to speak in this our trend following trading club meeting. I decided to do so.
Yeah, this is a particularly interesting period of time in the markets. We have all these trends. I've lived this charmed life since November of 20, with all these great um, trends in the commodities and then currencies, interest rates. Yeah, and that's about it. Plus and minus in the stocks, I would say. And now we're starting to see, some rallies off the lows and um, some retracement from the highs, and so our systems are sitting there giving back profits, and for the longest period, the diversification, wasn't really there in the currencies and the interest rates, but um, and that was fine because they were all going one way and we were making money. Now we're seeing more and more of, like yesterday was very interesting, where the interest rates in the U.S. kind of rallied a bit. The bond markets really didn't do very much. They were maybe unchanged to up, but the European interest rates, those markets were down. So we're starting to see a bit of diversification here, and even in the currencies. I've been getting out of some of my currencies and then staying short Aussie, Canada, and some of the others. And I trade a lot of the cross rates as well, and those are ignoring, what's going on with the dollar pretty much. So it really is, and I trade four systems. So I'm getting back to Rich's comment here, and that is that all this diversification we get in the systems is great. I only trade four trend following systems, but when I look across all of my trades, the amount of diversification that we get in the sectors by trading, 40, 50 currencies and 40, 50 interest rates, 50 some commodities, it's just quite amazing. And it does smooth things out quite a bit. And I think that the markets themselves are giving me this diversification that I'm not getting because I don't trade a convergent system, carry something with a negative skew that would really fit in well here, or shorter term hourly bars or anything like that that would really help out probably. So, but I am getting quite a bit of, diversification sometimes from just all of these different markets, and still primarily hunting these outliers. There are, trends in soybean meal still going on, sugar making all-time highs. OJ is still going up. So we are seeing outside of the different sectors some pretty fun moves. And Canadian dollar has kind of picked up to be the worst and weakest currency. So, anyways, it's just fantastic to trade all of these markets, and it really is fun to watch everything that's happening. And I just get the biggest thrill out of trading small and making all of these small bets and not stressing too much. But we'll see what happens with all these trends and see how well the long term versus medium to short term does.
Uh, I want to say that I really love diversification, and when I came to a conclusion, maybe 7, 8 years ago, I did my own research on different direction, as I have said before, and I came to a conclusion that diversification is a good thing. I remember that I was very happy. I didn't know then that period how to do it in a better way, but I thought that maybe trade different asset classes. Maybe it will be better, and I saw that it's better, and I was very happy on this stage of my of improvement of my knowledge because of my own research, because it was maybe 2015 2016. I didn't read books, didn't watch video about trading, so I did maybe I think 90% of what I did I was doing by myself. So, and until I have found top traders unplugged, I trusted to nobody. I really, the first people I trusted was top traders unplugged. I mean, systematic. It was Niels, Maurits, and Jerry. The first people, and I listened to them and understood that I want to trade like they teach. It was the first. So
I was thinking, Jerry, that wouldn't it be great if we find that we have a decade or so of this regime that we've experienced over the last couple of years? And, that's entirely possible. We've seen that in the sort of the 80s and the 90s, didn't we? So, you know, who knows how long this regime is going to last, but it certainly is favorable for us.
I agree.
and
And as I've said before, in the 80s, so I started in the mid 80s, late 80s, and then throughout even the mid 2000s, early 2000s, all the marketing material would accurately show how diversified trend following made more money than stocks. Obviously, had more diversification and less drawdowns and things like that. So we're just in a situation where all of these wonderful markets that we trade, that all we try to do is participate in the trends and hold on, and they just provide us with all this unexpected and undeserved wealth if we can just let them do their thing and then get out of the way and don't screw up something, don't screw up these big trends. So I think it's definitely possible, as long we could get back to that, which is I think normal. And then what happens when we get back to the normal? I mean, since then we've added more markets, we've become better at what we do, and it could just be way better than it's ever been before because of the increased markets. Now, the industry itself, the managed futures industry, which I'm thankfully not really a part of, needs to adopt the single stocks, trade those, and make that particular sector have the same potential for these outlier trades and get rid of trading these indices, at least on the long side. But I don't see that really coming. But I do see that over time, some large organizations will do that, and then the traditional CTAs will be scrambling to catch up because all of a sudden it'll become magically known that you should trade stocks and individual stocks and let them and trend follow them and play for the outliers and handle them in the exact same way that CTAs handle all the other markets. Would never in a million years trade the dollar index only. Never in a million years trade a commodity index. And yet perfectly satisfied for no good reason to trade these stupid stock indexes. So I think what we're going to, as long as the manipulation of the economy and the money and the debt from the central banks has run its course, I think we're going to be in pretty good shape.
I want to say that I like the idea of Niels and Mark Jabrinsky, and I agree with this, that our world now is deglobalized, and I see the signs of this. And in the deglobalized world it means diversification. It means diversificate world, and also it means that it's more freedom for the markets, for trading at all levels. I think more freedom, and I think, of course, it must be only so. And in Systematic Investor podcast, Niels, Jerry, and Maurits were often talking about that, and it was in 2018 and 2019 maybe. that, especially in 2018, that soon probably it will be a very trending period. It will be so because it's a loss of economy at least. And I believe that, and I believe that with 100%, on 100% that it's so true. And now we see how true it is. It is.
Yeah, thanks to everyone for finding the space this morning and starting at 8:30. I don't know what happened. It could be my fault, but so I had to switch over to my other account. And thanks for voting in the poll. I didn't think there was a big reason to switch our 8 a.m. Eastern time start, especially since my Aussie friends were saying, "Don't worry about it, we're fine." But 16 hours and coming up on 1 a.m. Aussie time, I know it's pretty tough. I'm a night owl too, but I probably would be in bed by 1 a.m. unless Rich was talking. So, if Rich started his own, I guess I would probably be up at 1 a.m. as well. But I got into this discussion with Oleg last night on direct messages, and I realized it was 3 a.m. Russian time, and so I told him, Oleg, go to bed, and I think he finally went to bed. So um, you never know. Fun things can happen early in the morning.
I I I love trend following so much that, in fact, there was a lot of nights when I was doing my research, backtest, and so on and so forth, and really I forgot about sleeping, forgot about maybe taking a meal. So I really love it so much that I feel fulfilled with it and with discussion. So even if it would be 4 o'clock a.m., 3 o'clock a.m., 5 o'clock a.m. In Moscow time, or any time, I will do all my best, all what I can to be in the spaces to talk about trend following, to do the research, to do trading because I love it. So there is no matter for me what time is it now, and even what meals I have eaten or have no no food at all, no sleep at all. I love it so much. It's really so.
So just let me know if anybody wants to join in and ask some questions or make some comments, and I'll put you on.
We've lost a number of our key speakers this week, Jerry, so it might be a bit tough going.
Well, we can do with a short, for us, a short spaces if we have to. I was on the TD Ameritrade TV show this morning. That's why I wanted to delay for 30 minutes, but it was kind of fun trying to talk about the markets and the trends from a group that's pretty much looking at stocks mostly and probably not trend following. And then I started to laugh when they asked me, like, what other markets are you looking at that are trend following? And I'm like, well, maybe soybean meal, that's a good uptrend. And sugar, probably two markets that not many people have in their portfolio. But I'm pretty sure sugar, there's an ETF in sugar. So you could definitely put that in your portfolio if you wanted to. But yeah, it's always a challenge to uh, get people to understand how powerful it is and how wonderful it is to not only trade hundreds of stocks, but put in all these different commodities, long and short, um, and the benefit that you can get. We come in with a stacked deck, and we have so much advantage when it comes to competing with other strategies. Obviously, the systematic approach, and then, but with all these different markets, I mean, as I've said before, to have a typical stock return of 8% a year with a 50% plus drawdown would be almost impossible for any reasonable trend following strategy that is medium to long term and trades a few commodities, currencies, and interest rates along with stocks and go short. We've seen this year how important the shorts are and not having to depend totally on trading markets that have shown to be add value to the portfolio from a long only point of view, which is so few, gold, real estate, um, Bitcoin now, but these things could come in and out based upon their performance on a buy and hold level. So great. We're pretty fortunate. I'm pretty happy that I answered an ad for Richard Dennis and not Warren Buffett.
And, and I want to say that it's really strange for me how little is trend following space. It's only maybe 4 trillion United States dollars, as I remember, or 4 billion maybe. I don't remember it's exactly, but I don't understand why. It's the best evidence-based thing I have ever seen, and I speak with different people, and even when I hear some people discuss stocks and bonds and something like that, there are no evidence at all. In fact, what they're speaking about, but they believe in that stock market will go up. But there is no evidence. There is no reason for stock markets to go up every year. And we trend followers, we just diversificate and we don't think about the reasons. So I don't understand why we so little investments in our trend following space, because it's the best strategy I have ever seen, and I'm 15 years. I trade for 15 years, and I did not see anything like this, and I really don't understand why so little investments in this.
The first hurdle that people need to overcome is the need to be systematic. So in the investing and speculation world, there's the discretionary managers and there are the systematic managers. So the first hurdle significantly reduces the share of people participating in it, which is being totally systematic. And then from there, we are just a small segment of that systematic space. So, but Jerry, you're standing now. How many markets are you diversified in? I think you're at 200 or so, or something like that. And your risk percentage, and what are the markets you are looking at as possible new markets to consider for additional diversification?
Well, I've got to transition. I'm transitioning into 300. So I was at 200. So it just takes some time because I've been doing this for a long time and I've made some mistakes, believe it or not, and I'm not wanting to make those mistakes again. And so whenever you change systems or you start adding markets, especially if you change your systems materially. So at one point I went from medium term to super long term. So managing that transition when you have lots of open trades, lots of big trends, it's a little dangerous to throw on this position. The market's gone 50 ATRs, and you're going to throw it on based upon the position you would have put on, 6 months ago or a year ago, and then your trailing stop is, going to be a long ways from where you actually put it on. So I've done that, and it's been disastrous. So I'm kind of waiting for more stocks and more currencies to become flat based on my system, and then on the next trade I'll throw them on. So here recently I've been adding a lot of the China currency crosses. This past few weeks I added Euro Poland, Euro Rand. I'm looking at a handful of more. I've made some good progress on interest rate ETFs, muni bonds, preferred, mortgage backs, tips. I have some more of those I'm going to be adding as those interest rate markets go flat. I mean, that could be a long, long time, or it could be next week. So, and stocks in the same way. A lot of the stocks I've had my eyes on, to add to the portfolio that would increase the diversification. They're in big uptrends, so I have to wait for those to kind of go flat. But probably in the first or second quarter of next year, I'll be at 300 markets, and I'll risk with a very healthy stop loss, not 2 ATRs like the turtles used to use, but much larger than that. My loss will be 12 basis points. So as I continue to add to get to this goal of 300, which will be 150 stocks, and then roughly 50 currencies, commodities, and interest rates, I will, as I continue to add, I continue to try, to make my bet size a bit smaller. So now we were at 15 basis points. Now all the new trades are at 12 basis points as we start getting to this 300 markets and 6 units. And 6 units is pretty healthy. And you don't want to, I don't want to go too much beyond 6 units when people are going, what does hell does 6 units mean? I'm like, yeah, well, you have to sort of read the turtle money management stuff that's out there online. But it's still pretty healthy. But I think the more markets I add, the smaller my individual bets are. Maybe I can go from 5.5 to 6 units, and 12 basis points sounds really small, but I don't vol adjust. I stay with the trade, and at some point in time, that little small trade could get very large because the ATR is just skyrocketing, and I'm not reducing that position. And I can have a bad month even with all these small trades, and at this point, about 250 markets. But yeah, I mean, I can have a bad month like everyone else, and I did in November. But I'm really pressing the bet on targeting as many outliers as possible and not manage futures, which I think if you're trading, the way they trade it with cutting the winners short a bit, 60 or 70 markets, doesn't really matter so much. But with me, I want to push the trend following and do something that no one's done with 150 single stocks and then all the rest of those markets, and trend following the world with as many markets as possible with the most optimal systems, those being the very long term that will have very painful drawdowns, and see how that's going to look, and to that particular strategy, real life trading. So I'm really excited about the foreseeable future.
Great stuff, Jerry. I'm really looking forward to seeing how you go.
And as I've said before, when I go back and do my research, which I've been doing for a long time on these particular systems, one entry, one exit, and a stop loss, average holding period a year for most of these systems, give or take, then these are the best performing systems that I can find. That nothing beats these systems. If you base your risk on risking 15 basis points, and so I don't pay attention to the drawdown or the volatility as much as preserving capital. And of course, I have this big edge in my trade level calculation. But when I see the performance and the back test of the simplest system, the systems that would be the easiest to replicate, and doing the trade on the open, the next day on the open, very few moving parts. The best way, the primary way that you're going to go wrong and overstate the historical performance would be not counting trading costs as much as you should, commissions and slippage and things like that. I've never seen a track record as good, a real-time track record from any trader as good as that. So, but it's the worst strategy because it does allow the markets to have these big drawdowns. And one of the main issues that's the problem with systematic trading done in this particular way is it pays no attention to preserving profits in the current trades. You're just out there with this trailing stop so far away, and then it usually works. It usually works. It works okay, right? And then if you do the back test, it works better than anything. But look, today we've got these trades, and they're counter trend. We're seeing rallies in the currencies and the interest rates, and it's painful. We do not want another month like November. But if you're going to follow these systems, the ones that have performed the best, you absolutely could have another back-to-back month giving back way too much of these profits in a year where you've been told all year this is the greatest trend following year of all time. And if you only pay attention to your trailing stop and don't use vol management, don't use correlation management, don't use dynamic position sizing, all the time you could have a very unfortunate quarter, month, and really look dumb. How in the world could you have made so much money through October and given back so much in the last 2 weeks or the first part of 2023? But this is what can happen. And this is why it's no surprise that substantial firms who can raise lots of money do not feel comfortable trading systems like this, irrespective of them being the top performer. And this is why interjecting some of this fall management and calling it whatever you want with any kind of rule that you want to call it, bottom line is we cannot give back too much of this profit that you will give back if you use these crazy systems that Jerry is advocating. And yet, these are the best systems historically. So therein lies the quandary. What are you going to do? Good morning, Michael.
Hello, everyone. Jerry, I see you changed the account for the space. I had a hard time finding it. Anyway, how is your win rate affected by this 12 basis points stop?
12 basis. Right. So yeah, that's right. So if I take a full loss, I'm going to lose 12 basis points. So, the only thing that's going to be impacted is that the more markets I add in the small, and I trade each one of them smaller, the each trade or each outlier is going to be a little bit smaller profit wise, but theoretically, I'm going to pick up more outliers. So it should be a reduction in profit, but more diversification and less volatility, and hopefully more compound growth. But it's not going to really impact anything other than making things a bit better. Now you have to buy into this idea, number one, that you're going to play for the outliers, and you're going to play in these markets where you're going to get a huge contribution from 5 or 10% of your trades, and be happy with that. And as I've said before, to some degree, when you buy into this philosophy, you I have the most diversification than any manager going 300 markets like this. Yet, I'm not paying very much attention to diversification. I'm treating each trade as not as if it's part of a sector and being super careful, in the sector, but I'm expecting to have a nice move in the grains or the nice move in metals or a nice move in currencies and bonds, but that more than likely some of those are going to have, as they are high correlated to the rest of the sector, some of those outliers are going to come from markets that are moving similarly. So I don't think we've seen that as much this time. Maybe the yen was the big mover, especially if you didn't vol manage the yen, and maybe the Canadian dollar will be next, or the short-term interest rates have been much better than the long-term rates. So we are paying attention to diversification, but not trying to scale back positions or adjust positions based upon correlation. I just pretend that they're not correlated. At some point in time, they won't be correlated. I've mentioned many times how I've made a ton of money in heating oil over the years, a few trades, and crude kind of sat there. And the same thing in silver. And so it can happen where we are thankful for the sector moves that managed futures CTAs profit from, but us outlier CTAs, classic CTAs, we're going to profit mostly from outlier trades, sugar only, or coffee only, or OJ, but also within a sector move, the pound or the gilt or something individual like that, we definitely expect it to go crazy and possibly have a big outlier move.
By the way, I often remember and I often think about this story with silver, and as I remember, it was in 1994. Jerry told it. The silver move and crude oil and heating oil, as I remember also that one of these markets dropped very skyrocket to the moon. So as I remember, so it's very interesting to think about these things. It's very interesting about this.
Jerry, if I may ask, what's your win rate this year?
Well, I think historically my win rate is around 40%. I think that's pretty typical of the long-term breakouts. And then I think it's very important. Your win rate is going to be heavily influenced by your stop loss. So if you're using 2 ATRs, your win rate's going to be lower. If you're using 10 ATRs, which maybe sounds a bit high, it's going to be higher. It's going to level off probably around 5 to 6 ATRs, and it's going to probably around the 40% level. I try to add a couple of filters that would help to improve my trade selection, but they have marginal value. And then, of course, the most important thing about trend following and filters and is to not ever have a filter that prevents you from eventually taking the trade. It just slows it down or speeds it up. But I'd say that I'm not sure about my recent win percentage, but this year or the past few years, it's probably been pretty high because I have 100% winners in currencies, 100% winners in interest rates. Well, probably 99 in interest rates. Commodities, very high in commodities. Probably stocks, because I'm long a lot of stocks and short some stocks as well. And I'm probably doing better than most CTAs typically daily when it comes to stock trading because I'm pretty balanced long and short, which is easy to do because, as I've said, there's many stocks in uptrends, many stocks in downtrends, but my win rate is probably a little high right now. But yeah, so I don't really pay that much attention to it, honestly. I just wrap myself with my back test. And whenever I get a bad performance or unfortunate give backs, I just like look at that back test and say, look, this is all I have. This is what I've always used. You've got to play a long game and not get too freaked about recent performance.
And I want to say that not only a backtest. Of course, backtest is a wonderful instrument, but for me personally, it's a logic behind this backtest, and this logic, this philosophy, is wonderful, really wonderful, and it's checkable. It's checkable to see that it's 100% logic to be in a good shape if you are a trend following trader in the long run. It's 100%, I'm absolutely sure that 100% is winning, your winning rate in the long run.
Jerry, thank you for answering all these questions. So your experience is valuable to many people. Another statistics, if you have it, what's the fraction of your trades that hit a trailing stop versus those that just stop and reverse from long to short or vice versa?
Oh, very good question. I'd say that 60% are losing trades, but some of that 60, I lost money and it actually exited on the trailing stop prior to the maximum stop loss being hit. Um, but I don't really know that number, honestly. I have not ever looked that up. But that it would probably be a small percent. I actually ran a back test one time. I think I like to run these back tests by coming up with these ideas of what's a really painful thing for people. Let's try to create a system that really does things that people don't like. I wouldn't like. Traders don't like. And one I told you about was try to buy the high of the day. Like when I first got into business, I was learning how to trade from ex floor traders, and there were floor traders there, current floor traders, and like people get really bent out of shape when they buy the high of the day, or they get a bad fill, and they're very concerned about these fills. And so I said to myself one day, I want to try to buy the high of the day. I want to try to sell the low of the day. And I want to be as perverse as possible and wish bad things on myself. And they're not bad, because when you try to buy the high of the day, sometimes you're not going to be able to buy it. You won't buy at all, and you'll miss a bad trade. So it's always pros and cons. And so we wrote this algorithm where we gave it our best shot. It has to close on the highest high and all of this stuff, and it ended up adding about 10% to the trade. So I think this pursuit of painful things, and then we wrote is beneficial, and then we wrote this algorithm where we tried to not get out of a loss unless it was uh, the maximum loss. So we tried to get rid of losses that were less than our maximum loss, which we would get out of if the trailing stop was hit prior to the stop loss, and that added value as well. So holding on and forcing yourself to take that maximum loss, which is something no one wants to do. Um, this is something this is how we were pursuing research, just to try to add a little tiny bit of value to the average trade, and that's what we looked at. Like, okay, if the average trade is 3 ATRs, let's try to make it 3.5. How can we get that? And we basically just were always saying, pretend we're sitting at the blackjack table and we want to make money. We want to have an average win on each hand. We want it to be higher and higher. We want to continue to have these juicy trades. And that's exactly how we would approach research, almost without any regard to volatility, but more about preserving capital and having these juicy trades. And these 15 basis points or 50 basis point losses, they can add up. And you have to really pay attention to your win rate and your average loss and your expectation per trade. I mean, that was day one of the turtle class. That's here we go. Expectation of the trade. This is what's very, very important. And then over the years, I have stayed away from being too concerned with volatility, especially on winning trades. And I really think that one of the things that these systems are very good at, it's the system and the diversification. They're very good at making money almost all the time. For my first 10 years in business, we made money every year. Or maybe it was 8 years, something like this. And the systems were not that great. And we didn't trade as many markets as we do now. But that was one of the great things about trend following, is that the trailing 12-month return, uh, you can get it up into the high 80s or 90% positive. And I thought, that's a great metric to shoot for. That's what really clients really like. How frequently are we making money? Can we make money almost every year? And I think making the money and being more consistent on an annual or year and a half basis, where you can maybe make money almost every 18 months, show a profit. I think people really enjoy that, and it really is a much better metric than some of the more Sharpie stuff and more academic stuff that people use.
And I want to say such a thing that we don't have any hidden risks. We don't have this. So we make money every year, almost every year, in a safe way, in a really safe way. It not looks safe. It's really safe. No hidden risk in our trading strategy.
I have to agree with Jerry. All my analysis shows that volatility adjusted stops and vol adjustment in general over the long term adds white noise to the profits. Maybe for some year or 2 years, 3 years, they will help, the system to outperform, the symbol, not adjusted system, but over long term, the extra effort doesn't pay for doing these things. The key to trend following is patience and patience, and you have to follow the system and the discipline, and that's the key, not the volatility. And this is hard. That's why I was asking about the win rate, especially for new people to trend following. Like when I started many years ago, the win rate below 50% was a real disappointment, to see like 8 consecutive losers, 10 consecutive losers. It was hard. And the people, and that's why although I made money, most money I have ever made were from trend following, period. Okay. But I wasn't good for that kind of discipline. So I moved to short-term trading, volatility, and other things, options, but short-term. But the people that were able to have the discipline to stay with long-term trend following made a lot of money. And this is the key. It's the win rate is low, and you have to have this discipline. You have to avoid getting disappointed by the losers, the consecutive losers, and get that outlier. And this is hard. Some people try to shift the debate to volatility adjustments and dynamic position sizing. Doesn't make any difference in the long term.
Yeah, I couldn't agree more. It's really difficult, and I think that's one of the way that I was taught. This is one of the benefits. This is how you should seek to build your system and evolve over time, concentrating on doing hard things. And trading is going to be hard. It's going to be counterintuitive. It's going to look dumb. You're going to have to handle all these trades the same way. But everyone knows, that the dollar is turning around. Everyone knows that the lows are in, and like you're sitting there and you're being disciplined, and you can remember all the times that everyone else traded better than you because they overrode the systems to a degree. In these particular mechanical systems that we use, they have one reason that we use them is so we can continue to do the same thing with every trade for the rest of our life. Every time it hits that breakout, I buy. Every time it hits that downside breakout, I sell or get out with a stop loss. And so you're just every day handling these trades perfectly. It's just, how am I going to handle these trades? I'm going to handle them by following this system to a T, and always buy the breakout, always sell the breakout, always get out at the stop loss, and never deviate from that. And then my performance, what is it? It's the accumulation of handling all of these trades the way that I should. It's my system. This is the way I handle them. Maybe it wasn't perfect, but the amount of discipline that it takes to handle these systems, and if you actually do it the way you're supposed to, you can have a very mediocre process in something that's far from perfect. And over a long period of time, over years, you will come out ahead and be very happy that you did all of this, but it's hell to pay on a daily basis, monthly basis. Psychologically, it's very difficult. But the solution to all of this is very relevant. It's very easy, and that is make your system mechanical, hand it off to someone who's going to execute the trades for you, and don't ever look at it. But no one does that. It's like saying, I'll put a robot out there to play golf for me. Well, the whole point of golf is not to do well, it's to have fun. And if you shoot over 100, so what? You don't want someone else to play for you. You don't want a robot to play for you. But I think people treat trading like golf. I'm going to do it because it's fun. Okay, but it's serious business. It's money. And you can be disciplined, but every good trader, every system trader, they have to figure out a way to not be too involved with the daily trades. And I have not been, I remember the day I walked off the desk in like the 90s and said, okay, no more trading for me. I'm going to hire traders. My job is to continue to develop good systems, and hire programmers and hire math quants, and don't allow them to get too crazy and over optimize. That was my job the whole time, is that I was the optimization policeman, stopping really smart people from doing too much.
And for me personally, I have decided that I love this and I'm willing to pay that price, psychological price, and I will follow these rules in almost, not all, in all circumstances, because I love this. I want to do only this. It's one of my main goals. So I will do this. And I have decided this maybe a few years ago, and I see good results because of it, because of this decision.
I have to admit, Jerry, I have been using trend following in a discretionary way for several years, and I pick signals that where I believe the trades are not crowded. And for instance, 2 years ago, I picked up a trade in rare earths, and that was one of my best trades in the last 10 years. And as soon as I got out, the trade got too crowded and volatility increased. And just people, it was impossible to make a profit. The market was erratic. But now I'm thinking going mechanical. And I have the systems, I have worked for a long time, but I have to find someone to execute them, because I'm not very good in execution due to discipline and due to a tendency to analyze the markets too much. And this is a drawback in trend following.
Yeah, and it's this crazy equation. I mean, I think you could analyze these markets from a fundamental or from a chart perspective and just be right so often, and your win rate could be much higher than your trend following system's win rate. And then all of a sudden, you miss a big trend or two, and you mishandle a big trend or two. You get out too quickly, more than anything. That's the biggest mistake everyone makes, is I don't want to give back all that profit. And then you get out and it has 2/3 more to go. And so that's the problem, is that the win rate and our rate of feeling good about ourselves, this is very important to us. And yet we get overwhelmed by missing a big trend or mishandling a big trend, and the trend following wins. But it only wins because its primary objective is finding and maximizing these outliers, which are 5% of the trades. And it's a crazy equation that really rubs human beings the wrong way.
By the way, I identified this problem with not allowing the winners run. a few years ago, and I decided to do something with that, with my psychology, that I must follow these rules. As I have said a few minutes ago, first of all, I think we must identify the problem, and then just do something with this. Do something to be more strong. So that's my point. It's really a problem for many people, and it was a problem for me, but not now.
Yeah. Cordura asked me a question on Twitter. I find it hard mentally to go from 70 markets to 200 markets and divide a move like 2014's oil short in the expectation to get at least 2/3 other outliers of the same impact. Weren't you concerned about that? Absolutely, because my track record is littered with huge moves. Like I made, and that dominated my performance. When I was trading 20 or 30 or 40 markets, that's probably a good chunk of my track record. I made 30% in December 1990 in heating oil, and I made 30% for the year. So yes, my 2014 would look a lot different for sure, because I did pretty well in 2014. And in 1987, silver doubled. And there was other periods where heating oil one market was half my profit, only because I wasn't trading that many markets. But I think it's going to be better and to spread it out, because we're going to have a better period when the stocks do well. We're trading more stocks, 50 to 100 stocks in our portfolio, 25 to 50% of our portfolio, depending upon how confident you are that you can get a good diversified group of stocks after overlaying trend following on top of it. And so I think that my performance during those periods, if I would have done that, would have been much better. So I think it's very important to focus on those trade stats and say, my average trade is so great, it's so large, and now I'm trading so many markets, I'm trading them so small that you have no idea where they're coming from. And yes, nostalgically, I do love that 2014, that 1986, and all of those years, 1988, the grain moves, when I was trading 20, 30, 40 markets. But mathematically, we're in much better situation if we're trading as many markets as we possibly can, making these small bets, and letting those profits run, because there will be outlier profits from these markets that we add. In 2014, to make up for trading oil short, maybe not. Maybe not. Pick a year, maybe not. But then pick another year where your expectation would be to do a lot better than you did, because you're in markets that trended and you didn't even know about them. I didn't even know about palm oil, sunflower seeds, maize, white maize, yellow maize, rubber, iron ore, all these markets that I've added, the potato chip company that I added, and the French fry company that I added, and the wood pellet company that I added, and all these companies and markets and currencies. Yeah, I didn't even know about those. What happened in those markets? That's the question. What happened in 2014 in those markets that I wasn't even paying attention to?
What you're going to find, Jerry, is that you'll be betting smaller because you're diversifying wider. But the asymmetry there is still going to remain. You're going to have smaller losses, but you're going to still have these outliers. The relationship between the two is going to be the same. But what I think you will find is that your distribution of outliers in your time series through your broader diversification is going to be much more distributed throughout the time series. So you'll get less clustered outliers which is a symptom of trading too few things. You tend to find that your portfolio is dominated with these clustered periods of outliers. But as you increase your diversification, you get a far better distribution. So the lifting power of those outliers is going to be far better distributed, which is probably going to make you less volatile, and it's going to give you this lifting power.
That's right. And even though we are very conservative with our proper alternative way of calculating trade level and not using any of the or all of the open trade equity to increase our as a way to calculate the quantity for our trades, it doesn't mean that we don't want to move up that trade level more frequently like we could, the more diversified we are. So yeah, it's there's no downside to adding these markets if you have a system built with the philosophy that we use. And then I'm getting a lot of diversification from adding a lot of different types of stocks. And I spend a lot of time choosing these stocks, not based upon historical performance of the stock, but based upon the diversifying qualities that it might have. Like I said, some of them are commodity based, and I'm getting exposure in stocks and ETFs that, not index ETFs, but ETFs that give me exposure to things that I can't get in the futures markets. And I'm not going to go down without a fight and experience what happened with the stocks and these great, amazing trends. The only thing that's trended consistently over the past 10 years has been these stocks. Parentheses, I'm sure there'll be something out there today of questioning whether trend following works in stocks. Does trend following work on the markets that have trended the best? Essentially, it's what they're asking. Close parentheses. I'm not going to go down without a fight. And when major sectors of the market, of the world, trend, and the trend follower is sitting there twiddling their thumbs. It's kind of like, is there a trend follower somewhere that doesn't trade interest rates? Probably. What is wrong? Currencies? Maybe. Well, that's your bad. It's your bad not because all the managed futures CTAs claim that, of course, you should trade those markets. It's because philosophically, you should be searching the world over and trading as many different markets as possible and putting yourself in a high likelihood of getting on board these outliers. The same with equities, because some of these markets, Moderna, I have the same stories all the time. Moderna and Tesla were two that I had, totally random luck. But I'll have this random luck next year or the years in the future with some of the stocks I've added recently or have been trading for a while, because all of these markets have the potential to have an outlier move.
And the more markets you include, Jerry, the less you are tempted to apply hindsight bias to a discrete set of markets there that are the best performers. So there's so many pluses to what you're doing, I think.
And I think that when a person asks a question, does trend following works or not, it's the same for me. If a person asks a question, does the prices change or not? It's the same. Of course, the prices are changing. The prices are moving higher or lower. It's a nature of it's a structure of price. So I think it's not very, it's a silly, it's stupid question. Does trend following works on stocks or does trend following works? Of course, trend following, we hunt the outliers, we capture the trends. The trending is a part of a nature in general. So of course it works, and I think it always will be working, and it always worked. I'm absolutely sure.
Okay, Oleg, yes. I just posted again this my recent article about stocks, trend following for stocks, small cap stocks, where I put this question: does trend following stocks work in the proper perspective? And what is this perspective? When people say trend following does not work for stocks, they mean the Sharpe ratio you get is no better than buying and holding the index of stocks. And this is the academic approach. The academics, they classify trend following under momentum. They call it price series momentum. And they argue it doesn't work. I haven't seen one academic paper that claims trend following price series momentum works. Maybe there are. What works for academics is cross-sectional momentum, buying stocks that outperform and selling those stocks shorting that underperform. Okay, this is what works for them. Now, I'm not very fond of academics and the papers, and I believe most of them are written for the objective of tenure credits. But my analysis shows that for large caps, unless you have a very good selection of the universe of stocks you are trend following, it doesn't work in the sense that you get very high drawdown and the Sharpe and volatility and the Sharpe ratio is very low. But for small caps, and I think Richard mentioned this a few spaces ago, trend following works well, and because of the potential in that market, the fundamentals, and this is the, what differentiates the different type of markets where trend following works for stocks. They don't mean by any means that there are no trends in stocks, Oleg. They mean that these trends cannot generate a Sharpe ratio to match buy and hold. This is what, how I understand it.
Yes, but we know that S&P 500 have average performance 8% a year and maximum drawdown 50% per year. And it's a practical side of, we know it in fact, this is a fact. And as Jerry says often, that there is no professional trend follower who have 50% drawdown with an average 8% performance. So here is my point, that trend following is always is a more successful strategy than buy and hold, and I'm sure that it is so.
Yeah, many will disagree with you from the point of view that for many, many long-term investors who are very astute, these 50% drawdowns represent great opportunities for anti-martingale, averaging down, okay, in the markets. And for them, it's a great opportunity. So they love those drawdowns because they are very long-term investors. So this is a debatable point, how if you judge things in terms of drawdowns. And if you do, and the analysis I have done for large caps shows that the drawdown is about like 40% for trend following systems, or 35%. Now, this is a random variable. If your drawdown is like 30%, it can get up to 60% in the future. So this is not, some people will debate it. That's what I'm saying.
Yes, I understand this, but I think that trend following is more safe, certainly, because in trend following, I at least know what I do. I know the logic behind the strategy. I know I have a big back test. And when a person do buy and hold strategy, there is the future is unpredictable. I can say only this: that we, in fact, don't know what will the future bring to us. And the recent years, we see how it can, like Neil said, that people forgot, they lost their imagination of how world can be unpredictable. And I totally agree with this. And when we do adaptive behavioral based strategy, as trend following is, I'm sure that it's more safe than only buy stocks, even the best stocks in the world, and wait in something. And we don't know when we see drawdowns in stocks. We, in fact, we must only know the future uh, to be confident that it's all will be okay. Because the past here, like Jerry said, the history is not a good guide for such situation. And I'm absolutely sure in this. It's my position. I'm sure.
Well, I understand your point and I agree. The person who is going to retire in the next 5 years is scared of drawdowns. There is no time to recover. If those drawdowns, the recovery time is long, like from the top of the dot-com crash to the top of the great financial crisis, it was like 7 years for recovery. But there is a large class of investors with a very long horizon that for them drawdowns are gifts, literally from God, whatever God, a million gods out there. The Hindus have 600,000 gods.
Don't see the reason to be happy and be very long term in buy and hold in a drawdown. I'm happy when I trade, transfer and trading. I'm happy in a drawdown because I push myself better. I'm happy when I'm in a trading period because I'm in profit. So every day, happiness every day. But when you do something, you have bought something and you don't know the future of it, and this something get cheaper. I don't see the evidence. I don't see the reason to be happy with this. So I don't see the reason. I see the reason to be happy in a trend following drawdowns, but not in this unpredictable, strange situation. I see so.
Yeah, I mean, it is a crazy situation compared to us. I remember Richard Dennis talking about this um, from a risk point of view. That when you have this mentality of buy the dip and a non-trend following approach, then the trade gets better and better the more it goes down. And what do you do? What are you going to do if it keeps going? And you look back at a few trades in history, the small sample size of the drawdowns in the S&P, and you can convince yourself that, well, the 12 or 20 times this has happened, buying these drawdowns are a gift. And yet, Rich has mentioned, Rich Brennan has mentioned, if you have these kind of conversion approaches, throwing a stop loss in there, it'll save your ass, but it may screw up your strategy. If it is even a good strategy. So it really is, such a more fortunate and safe way of trading that by the mere fact that you have a loss, it's a worse trade, and you know exactly how to handle it. You take that small loss. Nothing could be easier. Putting that trade on in anticipation that, oh God, it may be my 10th loss in a row. so easy. You're trading a lot of markets, you're trading with moderate leverage, you're taking these small losses. The easiest decision ever is to put that thing on and then take it off with a small loss. And yet, that's in our world. And the other world, it is so much harder because even when you do win 80% of the time with buying these dips and not paying attention to trend, and trend not being a signal of buying highs and selling lows is not something that you do, you will get caught in the other 10 or 20% of the time in really unfortunate situations with no clue what to do. And then being bold and strong to follow your system is the exact wrong thing to do, because that just means you'll probably not live in this trading world for very much longer.
I want to say that I fully agree with this, and we have 100% algorithmic math decision solution for this. And buy and hold guys, they have only a story, they have narrative, and their history. Like people learn history at school, especially with Russian history. There are different textbooks. We had Soviet period. It was one kind of textbook. In 90s we have another kind of text, another history, and nowadays we have another history. And they say that previous version of history wasn't truth, and now it's a truth every time. So we see it in Russia. And I want to say that I see something similar to that. We have only history that historically stocks are a good thing. But if we have no decision for this, and by the way, historically, if we look at real history, it's not. So we have seen a periods of underperformance of stocks for 25 years. I have seen this chart for 100 years. In 100-year chart, 25 years of underperformance and 15 years of underperformance. I remember from 1960 to 1967. I remember this is 16 years. So they don't have any solution for that if their story will not match the reality. No solution for that. And we have a mathematical. Math is a universal language for all nature, and we have this natural mathematical solution, and they have only story based on nothing, in fact.
Yeah, don't misunderstand me, Oleg. I just refer to the arguments the buy and holders make in this area, and I have I had discussions with many of them, and their arguments, are good as long they claim, as long as the U.S. dollar is a reserve currency and the U.S. dominates technology, which does. They see some average long-term return of about 8 to 10%, and they find these drawdowns as opportunities to add to their positions. I mean, this is a reason. Now, that doesn't mean they will sit there and take a final 100% drawdown. Okay, that doesn't mean. I mean, even buy and holders are active investors. They use timing. Buy and hold is just, a term.
I understand this, but I don't see any effective solutions in buy and hold, really effective. That we can see doing a back test for all the data. And even if we will do the back test for all the data, it's a lot of room for surprises in this strategy. A lot of because our world is very surprisingly place to live, and we see this.
Definitely, I agree with you, and things can go wrong, and like this year with the 60-40 investors, they have problems, but that's their arguments. I like to ask Jerry about the 12 bips stop loss, which essentially determines the position size per trade. With 300 markets, you will be 36% of your equity will be in the markets. Do you think this is a lot in case of markets get too correlated and there are increased margin requirements? Can that create a tail risk for the manager at some point, or you don't see that possibility?
No, I mean, I think when you decide how large you're going to trade and how many markets, you need to be very careful with that. That's your most important initial decision. And it is going to have a big impact on your ability as a human being to follow your rules and not freak out. Now, we walk through this, and based upon the back test and our experience, we tell ourselves little stories. And one of them we say is, we're going to be very concerned with preserving capital. And if every one of these positions that I put on, if I have to put them on the same day, this is going to be very troublesome, right? Because you could absolutely have almost all of them go against you. But if all of these different markets and all these in the 4 or 5 different sectors, if they are spread out over a lot of different times, like I'm entering in these markets at all different times, some are long, some are short, then I'm lessening my possibility of having a losing trade. Because I've told myself the story, that's what I'm concerned with. Did I actually take that 12 basis point loss? And as 12 basis points is super small, multiplied by 300, not that small. So thankfully, I can look at history and the back test and say, I really do spread these trades around. They're all getting in at much different times. I keep track of the number of days I've been in all of my trades, and it ranges from 1 to hundreds. And even within the same sector, I won't always put the trades on close to each other. So that's my main concern. However, everyone else is interested in what? The drawdown. And it's all happening at the same time. But the trend follower said, I don't care about the drawdown. These things are going to occur. I only care if I'm actually booking these 12 basis point losses over a short period of time, one right after the other, multiple in the same day, and that is unlikely. When you overlay the trend rules on top of all of these markets, even stocks, you're going to have a tendency to get in them at different times, be long and short at the same time. And when you do have a lot of these correlations, you have a chance to be long and short. Or here recently, when we've had counter trend movement against our good positions that have been trending for a long time, they've been trending for a long time. We have massive profits built up. And so we're not going to be the type of person who says, well, I'm happy with profits. I just don't want to ever have any profit give back. Well, that's silly. That's immature, whether you're a grown man or woman. But I look at a lot of these systems and methods that have built into them the intolerance of having any sort of material profit give back, and I think that's immature. This is not how the world works. We can walk out of this game with a little bit more money than we came in, and we ought to be willing to accept a bit more volatility when things have been so wonderful for us, especially when you do the back test and the computer says, this is how you make a lot of money, by letting those profits run when everyone else is too afraid, and they're getting pressure from themselves or from others to don't let those profits get away. And they even go so far, managed futures CTAs go so far as say a profit give back is a loss. So the old cliche of take small losses and let profits run demands that the loss not be a profit give back. How could one let profits run and take a small loss? So it demands that you look at all of these trades as trades. On this trade, I'm going to take a small loss if need be. On this trade, I'm going to let profits run and sit with volatility, which I will have, but they've changed the language. I don't like it. I love Andrew. I think it's funny that Andrew is replicating the 20 biggest, most famous, smartest managed futures CTAs with 14 markets. I think it's funny. I like it. And when my ETF comes out, it will not compete with Andrew's because I'm going to trade 300 markets. He better get ready to replicate me with all 300 and figure out which 300 I'm trading, because I'm going to play for the big outliers, and it's going to be 5% of my markets are going to be what makes all of my money, not the managed futures CTA approach of sector moves. It's all about the sector, because if any of these outliers get out of control, if they become too outliery, I'm going to send them to the woodshed and tell them to don't do that. If you get too crazy, make me too much money, volatility scares me, and I'm going to cut that thing back so it looks like all the other markets. Thank you for letting me rant at the very end. I need to go to another meeting, and I appreciate everyone finding the spaces today, and we'll get this thing squared away. I don't understand why the spaces is working on this Twitter account and not my other Twitter account. So maybe I have some issues. Somebody said it's the new version of Twitter, the app, but I don't think that's the case because it's working fine. But hopefully we get a recording, and I will forward out Rich's recording later. And I wish everyone a good weekend, happy holidays, and sleep tight, Rich.